before we get to the market open, we have Gaurav who's joining back to tell us about the RBI credit provisioning guidelines which have come out and what impact that could have on banks, and they've been focused today. Gaurav, over to you.
Well, yes. RBI has now released draft guidelines for ECL as well as risk weight. So first, let's understand what they have changed in ECL guidelines. First is that they will be applicable from 1st April 2027 and the transition is allowed till FY32. So that is a positive thing for banks. Other than that, now they have added new classifications, which is stage 1, stage 2 and stage 3. Specifically, if I have to talk about stage 2, it is basically the loans which are past due more than 60 days. So this is something that they have added as a cushion, and there will be some provisioning which is required. So let's understand how the provisioning calculation is going to be. First is that the bank will have to consider probability of default, loss given default and exposure as default for the calculation, and at the same time they have proposed regulatory stage 1 ECL requirement of 0.25 to 1.25%. For stage 2, it is expected to be at 1.5 to 5%, and for stage 3, it will be anywhere between 25 to 100%. Now, as per Motilal Oswal, they believe that the top private sector banks are going to be the key beneficiaries like HDFC Bank, ICICI Bank and Axis Bank, because they have a large secured book. At the same time, they see limited impact on PSBs and bank with elevated unsecured and MFI exposure. Now, there we may see higher provisioning which will be required. But remember, it will be applicable from FY27. So we will be watching out on banks like IndusInd Bank, Bandhan Bank and RBL, how the commentary is going to be and how the transition is going to be from these banks. From the credit risk capital point of view, let's also understand what key changes they have made. First is that the LTV based risk weights for housing loans, now they have reduced the risk weights sharply to 20 to 40%, and they have increased the risk weights for commercial real estate to 150%. So it will be positive for real estate players, specifically who are in the affordable segment, and it will restrain some capital flow to the leverage developers. Second big change is that in the personal loan and credit card segment, although they have continued their 125% of risk weight, they have lowered the risk weight to transactor category. Now, remember, this will be positive for card players because they have 55 to 65% of the overall receivables, which is calculated as transactors. So definitely that is going to be a positive change for these companies as well going ahead.
All right, take that point, Gaurav. Thanks a lot for that.